Hello, ladies and gentlemen. This is Adam Koch, President and Portfolio Manager at Libertas Wealth Management Group in Columbus, Ohio. I just want to wish all our friends up north a happy Canada Day, as well as, of course, all of us here in the United States a happy Independence Day weekend. But let's go ahead and get started right away with our halftime report for 2016. So, first of all, moving on, before we even get started, I want to make sure everybody has optimized their viewing experience. What you want to do is on the bottom right-hand corner here, you just want to click on the little wheel, which will bring up some options for viewing quality. You want to click on the quality meter here, make sure it's as high as possible. You typically don't want to use the auto function, otherwise you might not end up with the highest quality audio. So, of course, you can always fast forward, rewind, pause, watch it again anytime, and let's just jump into the material here. Okay, well, let's just start off with a recap of what we already know. First of all, pre-election years, which was last year, are typically good years for the stock market. In reality, what we saw in 2015 was that we had our first down pre-election year since 1939, which obviously is not a good thing. Second of all, the Santa Claus rally. So the Santa Claus rally is the last few trading days of the year, as well as the first couple trading days of the new year. Typically, this is a good time for the stock market, hence the name Santa Claus rally. And this year, what we experienced was actually a 1.4% loss as opposed to a gain. Third, the first 5 days of the year, as well as the first 10 days actually of this year, were the worst for the stock market in history. January was the worst month for the S&P 500 since 1923. It was also the worst month for the Dow Jones Industrial Average, so the Dow, since 1900. And just to close out here, our quick summary, the 200-day moving average, which I'll get into in a little bit here in a little bit more detail, is currently flat, which means that we are looking at a market that's relatively trendless, meaning there is no trend. And of course, the old saying, sell in May and go away, is well behind us at this point. May 1st, it's been 2 months at this point, and obviously we are well into the seasonally weak months of the year. So let's go into some details. First of all, I know this is a colorful chart, but this is from Dorsey, Wright & Associates. I just wanted to share this asset class ranking chart. And what we're looking at here is a comparison between cash or money market, commodities, currencies, domestic stocks, bonds, and international stocks. And then we have a score here, which we won't get into that, but basically what we want to focus on is what the best ranked asset classes are versus the worst ranked asset classes, because obviously what we want to do is we want to focus on the best ranked asset classes. That's where we want our money. We don't want to be putting our money on the Cleveland Browns. As much as I love my Cleveland Browns, we don't want to do that. We want to focus on the best teams, in this case the Cavs, let's just say. So we want to be front runners. And in the beginning of this year, you could see here commodities were in the basement in last place. Now, they've had an unbelievable run between the beginning of this year and where they sit today. So you can see this is a weekly chart. So we've got the 16th of February. It moves up to number 5 out of 6. Right here on the 25th of April, it moves up to number 4. And then on the 20th of June, so just this past month, it moves up to the number 2 ranked spot before becoming the leader this past week, all as a result of Brexit, which we'll talk about in a second as well. On the contrary, we can look over at domestic stocks. Now, we're going to look at this in a couple different ways here, but first and foremost, I just want to point out that at the beginning of the year, domestic equities, domestic stocks, were very clearly in the pole position. They were very clearly number 1 versus the other asset classes. But then by February 8th, they fall to number 2. By February 16th, they'd fall into the number 3 ranked asset class. And you can see the overall weakness that has taken place since then. And this will make a whole lot more sense on this next chart here. So the first thing I want to point out over here on the left is that we've got the dates that the S&P 500 fell. And then, of course, we have the date, the score ranking. And you can see how the relative score of the stock market here in the U.S. fell as well. It makes total sense, right? This isn't all that confusing. So if we keep moving on, we can go back up to April 18th here. So April 18th, the market goes down for about a month. And of course, the score goes down. Again, simple stuff. Then from June 6th through the end of June, same story. Market generally went down. Obviously, we've had a rebound this past couple days, which we'll show you in a second here. But again, score goes down, generally speaking, with the exception of one little hiccup here, a head fake, we'll call it. So obviously, stock market goes down, ranking goes down, right? Stock market goes down, relative ranking goes down. We're just looking at stocks. That's it here in the US. And this is, again, just an overall view of how the relative performance of US stocks versus other asset classes such as currencies, commodities, cash under your mattress, bonds, international stocks. So how domestic stocks have done on a relative basis. So what I really want you to focus on here is from February 11th until early June, the S&P 500 went up 17.15%. But the relative performance of US stocks versus all the other asset classes that you can invest your money in actually went down a total of 13 points. Again, we had a couple rises in here, but generally speaking, we see a falling in relative performance overall as opposed to the market rallying to new highs. That's not good. That's something called bearish divergence. It's basically, we're seeing a negative score divergence versus the market going up. Call it a leading indicator, something that kind of gives you a hint that maybe something not so good is going on behind the curtain. So last but not least, last chart I'll show you, a relative ranking chart that is I just wanted to show you the Brexit because I found this to be really, really interesting. So the 24th was the UK leaving the European Union, so last Friday, and you can see here the US stocks lost 2 points on a relative basis. Market went down Monday as well, but the market went up on the 28th, 29th, as well as yesterday. But the score ranking still went down. I don't know about you, but I find that pretty interesting. So again, I mean, I don't think this is a good sign for the stock market. When you step away from the TV and the news, I think you want to focus on these numbers and these instruments and call it your tools or your instrument panel, kind of like flying a plane, as opposed to looking at the news or hoping the market goes up. So it doesn't really matter that the market headed back up recently. Things still don't look all that great right now. When we look at the stock market today, I find it interesting as I was doing this halftime update and kind of putting together all the charts that last year when I did the halftime update, the market's sitting almost where it was a year ago. So isn't that crazy? Market's gone out almost absolutely nowhere in 12 months. Further, back to bearish divergence. So here again, this is the stock market today since November 2014. So you can see here, market goes up, pulls back, pretty big, actually a correction, we'll call it, in August, September, rallies to November, falls again through February, rallies again, but we're generally seeing lower tops here and of course lower lows. We don't know what's going to happen going forward, but what we see recently, just since April, is the stock market has kind of formed some higher highs with the exception of this lower low with the Brexit. But we're seeing what's called the MACD, or the moving average convergence divergence lines, showing lower highs, or in other words, bearish divergence. Again, this is something else that makes us look at, if you're looking at your charts and if you're looking at your numbers, this is a bad sign for the stock market right here. We don't want to see the MACD declining in strength while the stock market's going up. We want to see it increasing. We want to see enthusiasm, and that's not what we're seeing right now. Furthermore, while we're not looking at extreme overbought nature in the market right now, this most recent rally this last few days obviously has brought the market up to a not a really overbought status, but relatively overbought as compared to the midline. But so, you know, if you're looking to buy stocks, which again, if I were you, I would definitely not be buying them here. Backing up for a second, anybody who wants to argue with me, again, I don't have an opinion on the market. I don't say the market's going down because I think it's going down. I simply look at charts. It's pretty much simple. I don't tell the market what to do. It tells me what to do. And when I look at this chart going back to, again, November of 2014, what I see is a downtrend. You can't call it anything else. I don't know what else to say. You've got lower highs, you've got lower lows, and until that changes, then as far as I'm concerned, the market is in a long-term downtrend. You also have the 200-day moving average here, which is the average movement of the S&P 500 over 200 days, which is generally flat. Some might argue and say, oh, well, it's pointing up right now. Well, that's fine. It pointed up back here too in November, and look what happened to the market thereafter. So you need a whole lot more evidence than just a couple short-term indicators to tell whether or not you should be in the stock market right now. And the great thing is you don't have to buy stocks to be invested. There's other things we can buy. There's a whole lot of other things we can buy. I wanted to share this chart just because I shared it last year. I updated it so it's current to date. You can see back here the 2007, 8, and 9 market crash. The market goes down almost 60%. That's 60, not 16, but 60%. And then, of course, we have right in 2009 the beginning of the first round of stimulus or quantitative easing. So QE1, January 09 to March of 2010. Market obviously does pretty well during that time period. Then all of a sudden, things kind of start to falter. We get a little bump. They falter again. We see some struggle here, and right here between, I'll call it September and November of 2010, we have anticipation. In other words, there was a lot of news back then that we were going to see another round of stimulus, and sure enough, we did from November of 10 to June of 2011. And there's another round of stimulus, and there's the market going up. What happens after the stimulus ends? Market goes down. Pretty much no surprise at this point. Operation Twist, and again, we saw the market go up right when Operation Twist round 1 ended. You can see how the anticipation of that ending of stimulus caused the market to fall a little bit, and then we see another rise. Ben Bernanke back then is who was running the Fed at that point, didn't even wait to see what would happen with the market this time. He decided, let's just throw in QE3, or what we called Q Eternity, which was at first about $40 billion a month in stimulus, and then turned into $85 billion by December of that year, 2012. And then they pretty much ran it until October of 2014. Since October of 2014, there has not been any stimulus package implemented whatsoever, and the total return as of the market close, or I should say intraday, on July 1st, as I'm putting together this video, the market's only up about 4%. 4% in 21 months, or in other words, in 1 year and 9 months, the market's again gone almost absolutely nowhere. Been a really, really, really tough market to try and make money in. Backing up for a second, let's just looking back to 1996 in the stock market. We've got a big rally here. You got to love the 90s, right? Made a lot of money back then. Then all of a sudden the market crashes, goes down 47%. Then market bottoms in 2003 March, rallies all the way up to the peak in 2007, and then crashes again. New lower low, and we lost about 57, more than half of the world's wealth lost in the S&P 500 during that 2+ year time period. Then we have the second longest bull market, or in other words, second longest up market in history, which is what we're living in right now. And again, going back to looking at the evidence here, I mean, what's the probability that the market continues going up from here when we're living in the second longest bull market in history? I'm not trying to say that I want the market to go down or anything along those lines. Again, we're just playing the evidence here. Does it make sense to continue investing in something that has gone up for so long? And you can see how long it takes for the markets to crash in the past. Most people don't realize that. Market peaks here. This takes a couple years before it crashes. Same here. 2007, the market peaks. Market didn't bottom till March of 2009. That takes a long time. So what's going to happen going forward? I don't have a clue. No one does. But July is the best performing month of the third quarter during election years. Good news? Well, maybe. So going back to 1952, you can see the average return of the Dow is 0.3%, average return of the S&P 500, 0.2%, NASDAQ's down 1.3%, Russell 1K and 2000 are down 0.3%, 0.9% respectively. But this is just, it's not saying a lot. I mean, just because July is a great month for the third quarter, you have to understand that, again, we're living in the seasonally weak months of the year, first of all. And second of all, August and September are horrible months for the market. Never mind the fact that we're in an election year, which is obviously creating a whole lot of uncertainty, especially when you consider our presidential election and the candidates and how nasty this is probably going to get. Speaking of the election, right now, try to ignore all the noise here. This is the best chart I have. Stock Trader's Almanac does a great job of putting together some beautiful charts, looking at statistics and seasonality and election years and presidential cycles and so on. So this line right here, this is where we're at. And this is only updated as of early June. This black line is the average 8th year in a 2-term election cycle. And again, here's where we are right now. So not to say that this is going to continue down from here, but it could, because again, the black line is the average of 8 years in a 2-term election cycle, which means half are better and half are worse, but this is the average. So, down right around 11% or so in those years. Back to seasonality just briefly. I know I've mentioned this a bunch of times in the past, but I want to bring it up again because, again, we are living in the seasonally weak months of the year. And what that basically means is, as the old adage says, sell in May and go away. And this only refers to stocks, though. That's why I want to really clarify. This has nothing to do with currencies, commodities. This has nothing to do with bonds. So we're only talking about stocks here. But when it comes to stocks, this is the Dow in this case. If you invested $10,000 in the Dow on April 30th, so right before May 1st of 1950, and you invested that and sold it on Halloween of 1950 and went to cash for the wintertime and went on vacation, so let's just say you snowbird, but you sell your investments too, and then the next year, 1951, you invest the proceeds into the market, into the Dow Jones Industrial Average on April 30th, 1951, invest it until Halloween of that year, sell it, and so on and so forth. You keep investing on May 1st, selling on Halloween. By the end of 2015, your total $10,000 investment over that time period would actually be down $323. Doing the exact opposite in the Dow, investing $10,000 instead of doing it on April 30th, instead investing that money on Halloween, investing it until April 30th, and then going on vacation for the summer, that same $10,000, doing that every single year is worth, you've made $843,000. So I think that while some people like to make fun of adages and little catchphrases like sell in May, go away, I think that you cannot deny that there's a lot of merit to that saying here. So what's our game plan going forward? First of all, again, we're living in the seasonally weak months of the year, which means it's kind of like swimming upstream, so we got to be really, really careful what we invest our money in. And in my opinion, at least for now, the market is telling me that I probably don't want to be invested in stocks. Second, the worst quarter of this year lies ahead. We're starting it. It started today. Third, again, our focus is on non-stock investments. I wanted to keep this as simple as possible, but I don't want to invest in stocks right now. I want to invest in things like commodities. I want to invest in bonds. No currencies currently, but these are the kind of things I want to focus our money on. And then last but not least, what could change all of this? What could change my entire report? Again, the market tells me what to do. I don't tell the market what to do. If Janet Yellen comes in from the Federal Reserve and decides she wants to implement another huge round of stimulus, well, that might change the market pretty quickly, and we might see a huge rally in the market. And if that's the case, then we might want to get back into stocks again, and we'd have to do it relatively fast. So, again, being agnostic here, we're not trying to say we know the market's going down or we think the market's going down or we hope the market's going down, and therefore we're not in the market. That's not how we do things. The way we do things is we look at the market, we see what the evidence suggests, and then we invest from there. And right now, the evidence suggests that things not having to do with the stock market, so call it commodities, bonds, and things of that nature, are the place to be, and that stocks are extremely dangerous right now. Just a quick recap again. As you go through this video, I'm sure sometimes this all might seem maybe a little bit too good to be true, but I want to make sure we all understand what I've said a million times before, which is we never, ever, ever buy at the bottom and sell at the top. That's impossible. No one can predict what the bottom is or predict what the top is. So what we want to do is we want to wait till we see trends moving up, and this is in anything, by the way, not just stocks, but in commodities or any other investment asset class, call it in bonds, whatever. So when we start to see something, an investment start to go up in value, we want to buy on the way up the hill and capture as much upside as we possibly can. Furthermore, when things start to peak out, what we want to do is we want to sell as soon as possible, and we want to get out of the way of the freight train on the way down the hill. Now, it obviously doesn't always work out that way, but that's the goal. This is what we're trying to accomplish here. But this is not an on-off switch. This is a dimmer switch. So when the market tells us that it's safe, that risk levels are low, and that this is a good place to be putting money into the stock market, then that's what we want to do. We want to increase the dimmer switch on the risk. Not turn it on, but dim it up. When risk levels are very elevated, as they are right now, what we want to do is we want to dim that dimmer switch down, maybe invest in other asset classes such as commodities, bonds, maybe spend a lot of time in cash, just literally putting our money into money markets and not really investing in much of anything. But as these sayings up here, or the quotes up here say, making a profit isn't enough. And what I mean by that is you have to keep that profit too. Making a profit's not enough, you have to keep it. Also, I was taught early in my career that you haven't lost anything unless you sell it. In other words, stay in the market, no matter what, it'll always come back. I disagree. I think that you haven't made anything unless you sell it. In other words, those profits can quickly go away. The market can take away your profits much faster than it took you to gain those profits. So you got to stay on top of things. You got to follow the market. You got to look at it. You got to pay attention. Imagine if you're on a plane flying at night and your pilot for whatever commercial airline you're flying on doesn't have an instrument rating. They have no idea how to read their instruments. How well are you going to do flying that plane by looking out the window when it's dark? So that's what investing's like. Investing's like flying a plane at night. You got to look at your instruments, and you got to have confidence both to win and to lose. And you have to have the confidence to fail, but you have to fail fast. And as I have said in the past, for one of my mentors always told me, it's okay to be wrong. You just can't stay wrong. So that's what we want to do. We want to be careful how we're flying our plane here, how we're flying our portfolios. Make sure we're watching our instruments. And Warren Buffett, a very, I should say, not so well-known quote, but I love sharing this quote with people because it's really, really hard to find. He said this in 1988, and the quote goes like this: "The disservice done students and gullible investment professionals who have swallowed modern portfolio theory, in other words, buy and hold investing, has been an extraordinary service to us," meaning the smart money, we'll call it. "In any sort of contest, whether it be financial, mental, or physical, it's an enormous advantage to have opponents who've been taught that it's useless to even try." What he meant by this was that the industry teaches investors that you should just buy, diversify, and leave it there. And when there's a very, very small group of people that know there's a better way to invest money than just to buy, diversify, and hold it forever, all of a sudden it becomes a lot easier for people like Warren Buffett and the smart money, and people paying attention to charts and paying attention to what the market's doing on details like we've showed you today. Thank you for watching. If you have any questions, of course, feel free to contact us anytime. You can reach us through our website at libertaswealth.com. You can follow the company on Twitter at LibertasWM. You can follow me on Twitter at Adam Koch. Or Facebook, www.facebook.com/Libertas Wealth. Feel free to look us up on the web on LinkedIn or Facebook. Like I mentioned, there's our URL right there. But again, if you have any questions at all about any of this information, please by all means give us a call at the office. You can speak to any of our financial advisors at our office, as well as myself personally if you have questions, detailed questions about the market and charts and so on. We're happy to help. That's what we're here for. So have a wonderful Independence Day. Enjoy the fireworks. Enjoy spending time with your families. And we'll look forward to talking to you soon.